I have lived long enough to know that opportunities must be seized or they will be lost.
Welcome back to Wall Street Radio. I'm your host, Tanner, here with Dan. And in this episode, we're going to be talking about some higher level market structure, what we've been seeing, and really what we've been seeing over the last 6 months, what got us to this point, because it's really easy to look at the action and make assumptions and kind of make calls in the current moment. But to really look back and understand why we're here, I think is also something that we should be covering more often than we are, especially considering we get new listeners all the time. With that being said, we do want to thank you guys for over 1,000 views across all of our streaming platforms for this podcast. We're really excited to continue to put out this type of content. And if you enjoy, leave a rating, leave a comment, send either of us a private message to let us know what you want to hear more about or what we're doing great or wrong. And we'll be really appreciative of that. So yeah, without further ado, let's jump right in.
Yeah, I mean, it's been a hectic market. I actually don't think it's been that misunderstood. It's been controlled selling, which I like to see. And that all goes down to this conspiracy type theme that we can spin the needle on, and we can go further in that towards the end of the pod. But the controlled selling is nice to see. I know people see, SPY's down 2%, 1.5%. It's had nice pushbacks up, like during intervals of the trading session, which usually makes buying opportunities really nicely. But as you said, like going from the very beginning, or at least let's back up like 2 to 3 months when Trump was, let's go to like November, when Trump was running after he got elected, what happened in the market, but also what were some of the precursors that people should have saw as to a pullback in the market. So Trump obviously wins the election, the market skyrockets, Tesla in particular skyrockets off of Elon's influence and intervention with the Doge department and all of his money going into Trump's election. And during that time, we were talking actively and starting to put out articles about two things in particular. One, you were focusing on semis and the influence of AI in the semi production and how that would be impacted, and then the energy demand from that. And you started to peel this web about infrastructure going on with Trump and his candidacy and his cabinet. I was focused on government contracting since that's what I did at Bloomberg. I was focused on, okay, if Doge comes in and they start reducing some of this department spending from a federal standpoint, right, those dollars go back into commercial corporations. And so that's going to reduce to lower sales, lower revenue, missed earnings, or at the very least, like re-guidance of next year, fiscal year 26, or the rest of fiscal year 25 earnings, which is going to lower the asset price or the stock price. So that's like very expected. And he also talked about tariffs a lot. Like he was running on a campaign of tariffs and taxes. And so what does that mean to the end all be all consumer? Or that just creates a lot of headaches for a lot of major corporations. It means that they have to pay more. And usually tariffs and taxes get passed on to the people. So then we have to pay more. And so you're kind of like, I'm not saying it's the right or wrong thing, because we've all known to balance the budget and to get the deficit lower, you're going to have to make very drastic moves, and ones that were not healthy for the market. Like we saw that and we talked about it time and time again. And now we're seeing some of this really start to play out. So I've just had this thought for quite some time. Like, it wasn't expected, but there are a lot of things adding up into the last 2 months that you could have saw this coming.
Yeah, I agree. And, if you look at some of the other themes that were primary Trump trades in the event that he got elected, most specifically deportation as a trade and, obviously the Elon trade, the deportation trade really isn't doing all that bad. If you look back at most of the market, you're seeing it trading below those November, below the election day. But the deportation trade is still managing moderately above. Byrna Technologies, Axon, and Geo, all of which were big Trump trades, still handling this kind of this volatility fine. Obviously coming off their highs, but not nearly as much, or retracing all the way back down to that election day. And as far as things being expected or the action being anticipated, I mean, if you go back to our earliest conversations back over the fall in my writing or in just conversations that we had, Trump is not good for big business, heavily globalized business, because of the tariffs that we know he's going to deploy, just like he did in his first term. So to see that initial run after the election made sense. I think people were sick of what they were seeing for the last 4 years, and a fresh face with new ideas was definitely bullish for the market. But in the longer term, and really when I say longer term, I really mean midterm, like 6 to 12 months, as he starts to roll these things out pretty much from inauguration day forward, then suddenly the market starts to price in what he actually is to the market, which is not great in the short term. And he's been very clear about that in his pressers, like saying, we're going to expect this short term pain because, like you said, it all comes back to the consumer, and that lower spending and just lesser spending is lower earnings for all these companies at the end of the day. Like recently, we just saw Costco miss for the first time in years, and I think a lot of that, we're seeing higher prices at Costco on staples already. A lot of that has to do with some of the action that we're seeing from this administration. So I don't necessarily think we perfectly anticipated exactly how this was going to go as far as the roadmap. I actually wouldn't have expected so much of a run after his election was announced. But now on the way down, it is becoming very clear, and it's easily understood, in my opinion.
Yeah, I agree with that. I didn't expect it. I knew it was going to gap up. I didn't expect the continuation of the gap up. I thought we were going to like have a moment of euphoria and then fall back down pretty quickly. I remember, oh man, when was this? It had to be probably around New Year's time. It was whenever crypto wasn't doing that well. A couple of your guys like were struggling. It must have been December, but I spoke with someone or spoke with a group of people about hedging specifically and how I was grabbing 575s on SPY and like taking them out. And that was well before Trump got elected, and that was going to happen whether or not he got elected. So this was another important thing that people should know is just technically speaking, and like there's very few technical correlators that I ride or die on in the market. I do like to buy value, as I've spoken about before, but there are a couple like knickknacks that I will never like forget about, and one of them is overextension on price and buying. And going into 25, like we had a historic year in 24. We went well above the Bollinger Bands. We were extended on price like crazy to a point where all moving averages were, again, like way left behind in the dust. And anytime you have that exaggerated buying for a consistent amount of time, and this was on the year. So I was looking at the 1 year chart for the S&P, which a lot of people are like, why would you look at the 1 year? Like, I usually look at the 1 day or the 1 week. But it's really important when you look at the 1 year because we've now had a lot of data to push that 1 year chart on SPY to understand like what its mechanisms and what the behaviors are going to be. And so I just saw, a while ago that it was probably gonna fade a little bit, and I didn't know when that was going to happen exactly, but Trump taking office, it was just bound to happen no matter what. So that's like the biggest thing is the technicals were saying it was going to happen. People are like, Trump is doing this, Trump is doing that. Listen, like his policies are his policies. I stay out of politics. I just try and influence and use politics to like best suit my trades. And that's why I'm like very middle aisle. I would have taken that 575 put whether Kamala or Trump won. Like you could have put anyone in office and I would have done that because the technicals do not allow S&P to make a run to 650 and 700. And lastly, the one thing that was very apparent is fund managers had key target levels on the S&P at 600. So I know there's a lot of de-risking happening as soon as we hit 600. And that means any move above 610, let alone 615, 620 was going to need substantial volume and pressure to the upside. You're just not going to get that, right? The market has to cool because it allows more entry points and it allows, at the end of the day, greater profitability for most fund managers. We saw Buffett store up on cash. I know there are a lot of other famous people who were famous hedge fund managers and wealth managers that were allocating a lot of cash towards the back end of Q4 24. But like, it's not hindsight's 2020 because like a lot of this, in my opinion, was about like seeing. It was pretty straightforward, like right in front of us, that this was going to happen if you just understood like what the effect was of the cause that Trump was going to create. The big question that I get from a lot of people is like, how do you trade around this? For me, I grab hedge, but like I'm not someone who's going to fully tilt my portfolio to downside and short just because of a slight correction in the market. To me, It's about having those hedges in place so you can make up capital and still stay ahead of the larger broad market. But at the same time, start to look at some of these dips. Like these earnings have now been undone. So like all gap ups have been undone, and now they've run below the 200. I saw a handful of names that had 15% gap ups on their earnings a week ago that are not only now below those, but below the 200, which is like another 10, 15%. For me, I'm like all over that. I'm adding positions, starter positions, but I'm taking on and adding every day. So whether it's been like a daily trade or an overnight trade or a starter position, like to be completely honest, this week and like the last 2 days of last week have been pretty profitable for me because I've just been buying purely technical oversold indicators on value names, and the market's been pushing them up around midday to end of day. So it's actually not been that bad overall.
Yeah, that's the thing is we really generalize these moves down as like, oh my gosh, the whole market is selling off. And yeah, that's true. But also some names are getting sold off more than others, of course. And some names are getting unfairly sold off more than others, right? Like you just said, we saw a lot of reports. I mean, I did, especially in like the power names, a lot of reports in the last quarter or two that have just been significant, really nice reports. And, they're selling down 50, 60, 70% from the highs over the last 2 months. And it's like, okay, I get it. The market's selling off, but there's some unfairness going on here. And that just creates nice opportunities for us to start, hitting our spots and really looking for stuff that we've already been talking about for a while. Like I'm not going out hunting for new value. Basically what I'm doing is I'm taking the names that I was already looking at prior when the market was going up. And I'm saying, okay, well, realistically, like what prices would these have to get to for me to be like, okay, this is no longer a technical trade. And this is just something that I want to add into because I think it's been unfairly sold off more than the others. Like if I look at all the power names, I think VST is the best of all of them. And from peak to current, it's down about in the middle of its pack. Well, just from a logical perspective, if it as a business is the best one of the group and it's down worse than some that I consider to be worse businesses, from a valuation perspective, if they were all running about the same prior, then this is logically an opportune time for me to start adding into that position. And I started to add into that on Friday of last week. And that yesterday, it saw a small decline, like a 4 or 5% decline. And now today, starting that bounce right back up. Powell as well. I added Oklo today also. All those names. Oklo's a little speculative. That's going to be the first one to go if we do get a nice bounce from here. But the other two, they just become so attractive at these multiples, like especially coming off of, like you said, great reports. It's like they report well, gap up, and then the market fades and it sells off well below even where the price was before the quarterly gap up. So it's like, okay, the market was trying to price in higher, market sells off, it pulls back, which made sense. But now that you've gone an additional 20% lower, it's like that to me is inefficient, and that's opportunity. And like you said, managers need this type of action to get entries on stuff like this because they do recognize that things get sold off unfairly, and that's what creates the best opportunity.
Yeah, without a doubt. And the one thing is all about opportunity. Like you got to take advantage of these times and make sure that you understand where your risk is, but where your cash flow is and your capital. And most people who stay engaged in the market but don't actively trade or really follow it on a day-to-day basis, they say for months and months, like, I want to get in now, or they just wait, right? There's that hesitation to wait.
Yeah.
When the market pulls back to 200-day SMAs, you don't wait. You start adding, because if you wait, it's just going to bounce back. And then you're going to be right back in the situation where you're saying, why didn't I add? Can the market go further? Sure. Like, where do I realistically see? I said this earlier, and I think it's pretty funny. Trump isn't dumb. He's a smart guy. He knows the effect that this would have on the market. And I think he said today or yesterday, if you're watching the stock market every day, like you're not going to see it reflected. And right, obviously you're not going to see the reflection of a healthier economy, like a lower deficit in the market. It's actually going to be inversely correlated for quite some time. But for me, the big thing right now is just making sure that I understand where my portfolio is, where the value names are, and understanding at any time, a lot of the pressure down right now is because of a handful of factors, but really like one or two, which has to do with tariffs and taxes and international tensions with Ukraine and Russia. if a report comes out tomorrow that Ukraine and Russia, like they responded today, and there's a 30-day ceasefire, I believe that was the news today, and that's why the market rallied midday. If that holds and we're able to find peace in that conflict, and then I saw news after hours today that Trump and Canada have already reversed the energy tax to some degree. Like if these things get repealed really quickly, this market's going to slingshot. Like I'm not someone who says the market's in like an unhealthy spot. I think there's saturation. I think there's fluff. I don't think we're in a position right now to continue to the 650, 700 level. We need some cooling and consolidation like we saw in 2022 if we want to make that next leg up. But 480, I think, was like the value when I was looking at fair value earlier on the S&P. 480 was the range where if we had an absolute drop, that's like where I see us going towards. If it's not 480, I think we actually cool and stabilize around 525 to 550 and make our legs back up. But again, like in terms of trading and staying as an active participant in the market, you can't wait to say, oh, I'm going to only have buys in at 480, or I'm going to wait to do XYZ. Like you have to start slowly adding in now, and don't try and catch a falling knife. Make sure you understand how much capital you want to allocate, designate a percent per week that you want to add or based off X metrics, and then do that. But overall, it's been for me a fun experience just because it's been controlled. It wasn't COVID. I mean, I traded actively through the flash crash, through the COVID crash. Like those were really violent. This is controlled, methodical. It seems like Trump actually understands exactly what he's doing. And that's why I want to make sure I have capital invested in these value names, because there's a deep, dark part of me that knows he's probably going to reach an agreement or a settlement all within like a couple of days or a couple hours. And the market's going to wake up 2-3%. And my names and a lot of these names are going to wake up 5-10%.
Yeah. Yeah. Regardless of opinions on Trump, he has delivered for at least the stock market better than any president we've ever seen, as far as like being so tied to it. And in the way that he negotiates and the way that he talks and has his pressers, he's so closely tied to the market, and he's really delivered, especially in his first term. I mean, I only caught the back half of it, but even still, I mean, it was such a seamless trading environment. And even though we've been going down since his inauguration, it's been some of the clearer price action that we've seen for sure. It's like you said, it's very controlled, and I'm of the opinion that he's going to pull some ridiculous trick out of his bag and managed to save the war in Ukraine and Russia with some ridiculous deal that, like you said, kind of beach ball underwater up higher. As far as like value that you were talking about, Christian Fromhertz has his value area, his yearly value area at 560 for the market. And we saw that tested today. So from that perspective, yeah, I mean, the value, this is like usually where we're going to get a bounce. I mean, I should probably have Connor on here to talk about this rather than me. But
that's a technical value, right? That's based off like average price of it volume? Okay.
Yeah, and it's like a fancy volume profile.
Yeah, okay.
Degree. But
so
he uses them a lot.
Yeah, so technically speaking, 560
was the spot.
Fundamental value of the company is 480 right now.
Yeah.
Like if you so that's a pretty big gap.
That is actually wider than I thought, actually, now that I think about it. But in any case, it does start to make these opportunities become a little bit more bearable. Like market might be down. The other thing too is sometimes your individual stuff, especially the more thematic, at least what I've realized is when a market pulls back, broad might continue down for another week or two, while the value that you're trying to buy can actually hold flat and then start to turn around. Like I remember in 2020, one of my first buys was AMD on the 19th. I pulled up some DMs because I was talking to a friend about it at the time. On the 19th of 2020, in March, I had purchased AMD, and the market continued to go down until the 25th of March. But AMD had started that rise from there because, it had reached its personal limit down. That value was like where people just couldn't accept the value going any lower. And you started to see buying on that despite the market continuing to go lower. So as long as you're staying positioned in the right themes and in the right names that kind of cut past any of this uncertainty around the world right now, in my opinion, you can you can front run the turnaround on the market. Like the market might not have bottomed just yet, but I'm starting to position in names that kind of ignore what's going on around the world and just rely on straight value and then straight opportunity moving forward. Like all these power names, it doesn't matter if the war in Ukraine ends. It doesn't matter if tariffs get applied or not. American energy prices are going to go up for sure, which is going to impact their revenue positively, of course. Or we need to build out infrastructure to continue to fuel AI, which is again going to just continue to increase revenue for them. So looking at what you're trying to buy, not only from a perspective of the technicals, the price, and the value, but also what is its relation to the market sell-off at all? Is it in a group that's impacted by these tariffs? I don't own any mega cap heavily globalized businesses, so nothing I hold really is ever at risk of being impacted by tariffs to at least to a large degree. So it's just a matter of where does the value align with the opportunity of this moving forward, and does that make sense for the portfolio? Because we're trying to catch falling knives here at the end of the day, and you can get caught in some nasty, swings down when that's the case. So managing risk appropriately, I leave bigger leashes on these bottom ticks than I do on like a normal trade. Like a normal breakout when the market's in an uptrend, I'll keep a very tight risk, and you'll just rinse and repeat over and over and over again, taking 1 to 4 risk reward, whatever it might be. But in these sell-offs, I leave a much wider leash for these stocks because I know that if I get even close to the bottom, I'm offered, assuming the market does go up from here, if I'm getting even close to the bottom, my entry prices they might never be seen again, for some of these names that have real value.
Yeah, completely agree. Example, I bought CyberArk yesterday at 310. The low was 306, 307. Today it was seeing 330. Like, you're not, for a high growth cybersecurity name or a SaaS name, and I want to talk about SaaS a little bit. You may never see that price again. It's very realistic that you won't. I mean, CyberArk hasn't even made it down to the 200 yet, and they already rallied it like 4 to 5% today. Because at the end of the day, like, they understand the value and the growth metrics of these stocks. And I saw someone talk about SaaS. It's actually been trending that SaaS is dead. And it's interesting because I like to actually, again, like, see both sides. I like to say, like, what is the contrarian view to this? And then, like, what's the bull view? And for me, SaaS, depending on the company, it can't be dead because it's so highly integrated into what these companies do today from a workflow perspective that the cost of pulling out a lot of these SaaS solutions in the company would cost billions of dollars. And it's actually not feasible for the production of the company. So is SaaS dead? No. I think is the small cap to mid cap SaaS more in trouble? Probably. Like, the things that can be removed from a business that cost nothing to the business, those are the ones you need to be watch out for. And that's where I think you need to understand, like, what the value names. But in terms of cybersecurity, nothing has changed in the past month in regards to the infrastructure that's at risk, right? Like, AI is developing, the offensive is developing at a high clip. We're seeing that all day, every day. And I think that's only going to escalate in the news in the coming weeks and months as we have this further development, is the amount of hacking that's going to happen. Like, these companies need to develop, and corporations need to be financially secure, and like, their information technology teams need to be secure. Like, you can only do that through a handful of companies. And so when I specifically look at this, I like, what is the risk to a corporation? Because a corporation is a lot of things. It's the revenue, it's the sales, it's the motion of the entire product. But a huge part of it's also the security of it and the legality of it. Like, the legal and security teams, the information security teams, like, they have a huge part in securing the length and the longevity of the business. And that's exactly where people attack. Like, a lot of hackers attack that because that's where client information, all the data lives, as well as the financial information. So for me, it's like, during this time, I agree that SaaS is taking a second look, but that's just because of the saturation that we've seen in that industry and the heightened exposure to, like, very large PEs that were taking place. And you're going to expect that in any type of bull type run, but SaaS is far from dead. I'm definitely going to look at a little bit of infrastructure as well, but, for my portfolio, which is heavily information security, cyber security, like I don't see that industry again, like it's not being impacted by tariffs. Like it is to some degree, but in terms of the core fundamental purpose of the business and the product, it's not. And the use case, right? The value proposition and the use case is really important to understand right now.
Yeah, it's also worth noting as far as the SaaS is dead. I think we're seeing a lot of that because with the introduction of AI at scale for young entrepreneurs, a lot of these SaaS companies are being cloned by much cheaper, newer versions that really aren't all that great. But it is happening. And I think that's why you're seeing a lot of this kind of SaaS is dead talk, because so much of it now can be cloned fairly easily with AI products. But at the end of the day, SaaS might be very easily replicable using AI tools, especially for a lot of the service side businesses. But the business itself can't be replicated. So similar to the reason why I think Adobe is a little bit more protected than people are leading on. You might be able to clone an individual piece of Adobe, make an AI version of one of their apps, but to actually run the business and to actually get returns for investors and keep it afloat and manage it appropriately, that's harder than it looks to do. And I think people are always going to overestimate something, especially when it comes to like the downfall of SaaS, right? They're going to overestimate the power of these little teams that are popping up with new products and adding a lot of competition to the market. But at the end of the day, I mean, the businesses that are extremely well run and efficiently managed, they're going to win in the long run. So I think that's really a short-term pitfall, if anything.
Yeah. Yeah, no, I agree. So S&P, I mean, it rallied intraday. It always does this thing where like it dies off most of the day. It has this rally till around 3 o'clock, and then the winds, they leave the sales and shorts come back in and they take probably a point or two off of it. And then it kind of muddles into close. What are you like expecting? I mean, it's only Tuesday. We still have 3 trading days left of the week. Like, what are you expecting per se about the S&P going forward?
Yeah, I mean, a lot of downside targets from people that I respect on Twitter was 560. So to see it trading right around in here, I would anticipate it to get hitched up. You also have it breaking down below a previous pretty significant pivot, which was right above 560. And a setup that I've really gotten accustomed to over the last year or so is the undercut and rally, where basically, you've got your price or a previous level, price makes a violent move below and kind of uses that pivot as like a magnet back up. And then you have like your undercut and your rally back through. And for V-shaped recoveries, like like it usually happens on like an index or a bigger stock. For a V-shaped recovery like that, you can buy back through that pivot without a real technical setup. So as far as like getting back involved technically in the market, I want to see something like that. I want to see us undercut that level that we already have over the last day or so. And then rally right back through that historic pivot. And then I think that'll open up the door for some opportunities. That's when I'm going to start to go shopping for stuff that's held sideways through this downturn. Because, we look at the market and we say, oh, it's Armageddon, everything's getting slammed. But I just ran some quick scans last night, and there is still stuff that's productive moving up. You're seeing staples do really well right now. I even saw, are you familiar with Portillo's? It's like yeah. Portillo's putting out a beauty bull flag, like through Armageddon, having no issue at all. So that's when I'm going to start to get more interested in taking those more technically based trades. But in the meantime, I'm okay with us hanging out around 560 and kind of building out here. Maybe even making like a rounded bottom would be fine with me as well. Of course, the famous V, which we've seen on SPY quite a lot recently. I mean, you get one good headline, one good piece of news, and it could start this little frozen rope type rally upwards. And that's why I'm buying the most valuable stuff now on the way down. In case we get that, then I'll have position, because it's really hard to get positioned on a frozen rope. So I'd rather be buying the value on the way down. And then for the more technical stuff that doesn't have to do with thematics or doesn't have to do with infrastructure or cyber or whatever it might be, that type of stuff I'll wait a little bit longer on. I know, you're kind of operating similarly to me at this point. It's, a month ago I was all technicals, all momentum. Now you and I are pretty much on the same page with buying into value here.
Yeah, it's just the way to go. It's the most comfortable trade for me in terms of
Yeah.
like sleeping well at night, which we both said like you just have to be able to sleep well. If you're doing that, then like you're probably allocating the right amount of risk, or you're a psychopath if you if you're full porting and you have no feeling at all about it. My big thing is that if we move into a recession or like we actually enter a full downtrend, there's I just thought about it too, because the 480 has fundamental significance, but also taking 20% off, like a normal recession or pull back into a bear market would take 15 to 20% off the market, sometimes 25%. But at 20%, you're at 40 from 600. If you're talking about the highs of what was our high, like 620, 615, somewhere
Yeah,
around
like
there.
12. Yeah.
Yeah, so if you're like taking 20% off there, you're probably closer, right? Obviously to that 500 number. To me, there's just a lot of room left. And the question I always have to ask myself, which I think is the understandable thing about why trading right now is pretty tricky, is because let's say we frozen rope, like we undo the tariffs, we get peace in Ukraine. Politically and internationally speaking, from a conflict perspective, things are tightening and they look sound and they look good. If we frozen rope back to 615 next week, are we ready to go to 650?
No.
Right? Like it doesn't
No.
feel right. At least when we had the cooling and consolidation in 2022, where like things had a significant downtrend and the market, it wanted and it needed time to just chill and like bring value back into stocks and let some of these companies bake in more of their price with earnings and the growth. Like that's why we had explosive growth in 23 and 24, because we had that cooling period where, again, you can bring more value into these assets before they go skyrocket high. That's my concern. And that's why I think even if we oscillate around 560, like we may make a pivot to 580, but I think we're just going to we're going to make a downtrend, because who's going to be buying at 620 next week? Or if we rally really hard, like I will still be trading the same way, which is more risk on. And so that's like kind of how I think about managing the portfolio right now, as well as like I'm adding in slowly, but granted, if we do frozen rope, I'm back into being pretty conservative, which I know like isn't fun, but like imagine if we made a run to 650 or 700 right now after all the things we talked about. Nvidia growth slowing, right? No starter homes for middle class, younger individuals, birth rates declining, the impact on colleges and institutions. Like there's a lot of problems right now. And those aren't going away. Those aren't easy to solve. And we're not even 60 days into Trump's administration yet. I can't imagine where we're going to be by June, July, right? Like there's only going to be more chaos, in my opinion.
Yeah, that's a great point. If you look at it that way, if we do see that rally here, all the issues that we've talked about over the last few weeks would still be true. Price would just be at all-time highs again, right? Besides maybe the conflict residing in Ukraine. But even that, like, how much of an impact would that have on American markets at this point in time? I don't know.
Yeah,
Something I'm not doing that I'm seeing a lot of is people day trading, man. I'm in a lot of groups, man, and I'm seeing some heinous behavior, to be honest. I mean, I'm seeing people just go, there's no setups. So naturally they're still going to look at the market. And what ends up happening is they're like, oh yeah, I'm just going to scalp to kind of keep myself busy. And like, I've never looked more like we got some degenerates out there.
yeah,
I don't think that's the way to do it in this market.
Scalping's so dangerous right now. It's not a bad thing, but if you're not a seasoned trader and you're over allocating on your portfolio and you're trying to scalp, because usually like most of the people trying to do that right now are smaller portfolios, which means they put in a high percent of their portfolio to scalp. And if it goes the opposite way, that's having a direct impact on a majority of their capital. Right. Yeah. People who are doing it the right way, like if you're using 2 to 5% of your portfolio and you're trying to take a position in something that you're not scared to hold as well, like that's a different story. But if you're using like 70 to 80% of your account on a name that you just found because it's down 10% and you're like, this has to be the bottom, that's, but it's a time, it's a tale as old as time. Like we've all been there, and you have to, right? The biggest lessons and the most painful lessons, like, they're the same thing in the market. Like you learn the most when you lose the most. And that's just kind of like the price to pay. That's why so many leave. But that's why if you make it 5+ years, 7 to 10+ years, you have scars, right? You have some serious scars of trades you've done poorly, and your account has those scars. But the idea is you learn and adapt and don't continue the behavior, obviously. But that's why they have Wall Street bets, for the people who just, they want to get that drug hit every time.
Yeah, I mean, I definitely remember early on in the career, trading through periods of downturn, periods of up, like basically just trading no matter what, because I was like, oh, I'm scalping. You can trade in any environment. And while yes, that may be true and people can do it well, I think you miss the biggest opportunities. You're so focused on your short-term trades. You're so focused on just making something for the day, the week, the month, that what ends up happening is if you had allocated all that time to thinking about the opportunity, thinking about the value, thinking about what's being unfairly sold off that might not even be impacted by the reason why the market is selling off in the first place, those are number one buys that are going to leave you with a lot less of a headache, because chances are it's going to be equity or longer term options. And number two, you're not going to have to think about every day going to bed like, what am I going to do tomorrow? What am I going to do this day, this day, this day? And then you flash forward a month, and let's say we do recover, right? You've been day trading all this time. Maybe you've made 3, 4, 5% on the account. You've missed buys. Maybe not generate. Everybody throws around the word generational wealth buys. Maybe not generational wealth buys, but you've certainly missed like cycle buys that are just, you're not going to get any better than that. So while I see a lot of people day trading now, and I remember doing it too on moves up and down, I definitely urge those who listen who are kind of caught in that cycle, like, take a step back, take this time not to think about how I can make money while the market's going down, but where is the opportunity and where's the value that might be underappreciated or oversold.
Yeah, it's so true though, because most day traders who are operating like that, it's a good test, right? Like, add up all the money you've made, and then when the market corrects, understand what that delta is between where the market is and where you are, because you're going to be behind. There's a reason that people buy, and then they should be waiting. Not only are you paying a higher capital gains tax, but there's no way that you're going to hit high every time. So for me, it's like, you have to buy, you have to hold. That's where the big money is made, unless it's like a short-term theory or idea. But even like people like to idolize Burry so much, and like the trade that he had, like especially like a lot of people who are newer in the market, which it's a fantastic trade, but people don't understand how long that trade took to come into fruition. Same thing with like the puts that I had as a hedge. I was down like 50% on those as of like a week ago, and now they're cooking pretty heavily. But it's like, the best ideas take time. Right, time and money gained in the market is usually synonymous. If you're making, and that's like the penny trade fallacy. It's like, yeah, everyone would love to get into a trade and make 400 or 500%. Realistically, doing that consistently is always going to be out of position if you're chasing that high in the market. So it's just something to, for people to think about. If you're constantly trying to chase the dragon a little bit in terms of trading, the market wants you to do that, right? Usually you should be doing the thing that the market, to some degree, right, contrarian, doesn't want you to do, doesn't want you to think about. You need to ask those questions. And usually that's where opportunity lives. And that's where arbitrage lives. And there's very few arbitrage opportunities, but they come up from time to time. It's just about identifying and doing the due diligence and the research and recognizing, okay, like, is this a period or a cycle where the market has misappropriately valued an asset, or it's not recognizing a certain idea? Like for me, it's not arbitrage, but for me, the idea that the market was, when we had that rally and that push after Trump got elected, even though he was saying that Doge was going to come in and cut federal spending and the federal budget, like, to me, it's like, instantly I'm like, okay, so like corporations, like the major Fortune 100s of the world, who have a ton of money invested in the federal government, and a lot of it makes up a majority of their sales, they're not getting that funding anymore, right? Like, that's going to have a significant impact. And yet the market kept rallying, and you see all of these names like Palantir, for example. Palantir was pushing 100 110, 115, and like good on them. I love Palantir, but talk about a company.
225x sales.
Yeah, I mean, talk about a company that relies almost exclusively, if not very heavily, on federal dollars, right? So it's like it's just about being able to call the bullshit. That's to some degree that's what arbitrage is, and that's why it takes balls, because you're usually going again like
Against the grain.
against the grain, and it can be painful. You're going to bleed, but managing your position is really important at that level.
Yeah, and then also when you think about like, I mean, you know me that I'm not somebody who shorts really ever, because tops are such a process. Like you can get caught with your pants down for months, weeks, before like what you want to happen happens, even if you're right, just because markets are irrational and that can be very difficult to pin. So you don't have to be somebody who is like, oh, I called the top. I'm going to trade down. I'm going to get puts because something's misappropriately valued to the upside or whatever it might be. For me, it's always about recognizing if things are, like you said, overvalued to the upside, and then not trying to pin the move down, but then just waiting for that opportunity when it presents itself at the bottom. Because, if you look back, like of all the study I've done of price action historically, if I were to run like a long short success percentage, my short success percentage is significantly less, and my gains from those shorts is significantly less than my long buys. Even if I'm just outright buying candles that make no sense to buy, right? It's just a huge gap down. You're like, okay, well, that's a good business. And, it's been above this price for 2 years now. It's trading here after one bad report or news or whatever. And that creates a good opportunity. So, I think at a time like this, for those that I'm seeing that are trying to kind of pin every move in both directions, it's like, take a look back at your data and see where like you actually succeed. Like I remember when you put those puts on, and not even once did I think to myself, I'm going to tail this, even though, I trust that you're usually right. Because that just doesn't align with my data or my stat sheet of like where I want to be buying. Or what I want to be doing on my portfolio just based on like personal performance.
Yeah, and that's the thing is I got a lot of questions that day about why are you doing it? Like how much should I hedge of my portfolio? A lot of people clearly, actually, I don't think anyone in that entire session was familiar with hedging or had been thinking about like, why would you hedge Trump and like him coming in? And it's like you have to always look at two views of thing, and that'll give you confidence, right? If you're leaning one way or the other on it. So you just have to, again, like that due diligence period is super important.
Yeah. I don't know if you caught this today, but Trump did declare a national emergency on electricity today.
Oh, did he really?
Yeah, he did. All the power names were juicing today, of course. But yeah, he did. I had to slide that in for a conversation point because China did it like 2 years ago. I think it was only a matter of time before the United States did it. And now that he's done that, hopefully we start to see some spending. Hopefully we start to see maybe some tax cuts for businesses that are developing any form of electricity. Hydro, I would expect to see more hydro. I would expect to see more natural gas. Hopefully more nuclear. We kind of went low on nuclear for a couple of months, these last few months since election, which I would have liked to have seen. But with that declaration today, maybe we'll start to see a little bit more activity in those markets, which all just supports most of my long-term thesis. But in any case, yeah, I thought that was pretty interesting. I also saw something that Canada was selling their bond position. I don't know if you saw my tweet.
Oh yeah, yeah,
yeah, with the Cheeto. Canada had said Canada files to sell U.S. bonds, size undisclosed. That means you have no size. If the size is undisclosed, you had no size.
Oh yeah.
Actually a Cheeto and a doorknob for that one. But I think a lot of that's just targeted headlines, obviously. Like they're trying to make it sound like it's a bigger deal than it is. But even if they said, I think the max, I was reading the comments, I think the max size it could have been was like 150 billion. I mean, Canada's not like a big US bond participant anyway. So I don't think that was a huge deal. Very small fry.
Yeah, it's not something to be concerned about. And I think the tension it's not at a peak, but I think it's just going to cool a little bit. Like people are going to start being, Canada's going to be realistic about what they can and cannot do in the future with imposed tariffs. And if Trump plays this game of like doubling down every tariff they send our way, like it's a really weird tactic because there's like zero diplomacy in it, but it seems like it's having an effect where, right, they get reversed almost the next day after they're announced. So it's something you have to just monitor every day in terms of that.
Yeah. Yeah. In any case, it's been an interesting week so far. I like the timing of when we started this pod because something's telling me if we had a Kamala presidency right now, we'd be getting on this call, sitting here twiddling our thumbs, going, what are we doing here? What do we got to talk about? So I love that there's so much action every day. I mean, I was, in a chat earlier today and somebody was like, this guy can't go 4 hours without creating a world breaking headline. And it's just like, dude, this is it. This is why we do it, man. Like this is great. So much action. His first term was like this too.
Yeah, it was.
It's just mayhem. And Connor was telling me earlier today that he saw some quote from like some Goldman analyst that was like, honestly, we have no idea what's going on. Like somebody was asking him about like what they were thinking about the action of Trump, and the analyst was like, we don't even know like what's happening. And I think that's
yeah, you can't. It creates an opportunity in a market for small like teams and also like individuals to outperform the S&P and outperform like large commercial organizations because there's so much chaos, and you really have to like sift through it. And sometimes, right, like the ones that are more pivotal and the ones that can adapt quickly are the smaller teams and smaller businesses. So like that's been really interesting so far. But yeah, I mean, the cool thing is that we shouldn't have a dry spell in the summer, which is nice. I mean, usually May to August is snooze town. I think it's actually going to be crazier than it is now because that's going to be, significantly at least into the ramp of his tenure in the seat. And so at that point, I mean, remember that the clock is ticking every day with him having a majority in the House and Senate. And that's why he's doing all this stuff, is because there's sand ticking away in the dial. And it's like, you only have so much time. Summer's probably going to be where he pushes. And especially before the federal budget resets in October, like you're gonna see a lot go through, in my opinion.
Yeah, I hope so, because again, a conversation that we've had on here is he kind of has to. If he's gonna follow this up with another Republican after his presidency, if that party is still gonna have the support, I think he has to take the brunt force of all of the decline that's going to come with his policy change in the short term. And he needs to do it fast, or else it carries on into his presidency. And then you run the risk of the market being in decline, which is so closely tied to Trump's reputation and really the Republican reputation, into the end of his presidency. And then you go into an election year, market's not doing so hot, recession's on the horizon. You can bet that they're not going to win again. So I think he recognizes that he's going to take the blunt force of it now. I mean, knowing that he's only got 4 years in here, he can't go for a re-election, so he can soak all the damage and then lay the foundation for a Republican to follow him up.
Yeah, I agree.
Yeah, but I think that about wraps it up for tonight. We do have another episode coming out on Friday, which is an interview with my brother. We had originally had video for that one, but it corrupted in the editing process. So we do have audio, no video.
Make it sound so official. In the editing process, it was corrupted.
the editing process, right? Or 4 cuts and whatever. But in any case, it's going to be coming out Friday. It's audio. It's with my brother Jonathan, who's a real estate agent with a team down in New York City. Featured on HBO. Really smart. Great guy. He's my brother. And he came and brought some insight for the housing market. Definitely check that one out if you're young, if you're looking to buy a home, or if you're just looking for an insight on a market that's not the stock market. That's kind of what that episode will bring. As far as future episodes with guests go, Dan and I have talked pretty significantly about what kind of guest we want to have on moving forward, and we hope that this one kind of sets the tone. We're not looking to have somebody on and just strictly interview them the whole time. We want to be able to converse with them, have real conversations about, maybe their specialty in the market versus ours. And yeah, we hope to have more guests on in the future. So definitely tune in for that one. Otherwise, I don't have anything else, and we'll see you later.
Now watch this drive.